Millions of Chinese-made product are on the shelf of your local store in America, but here's the twist. Many of those products got here without a single dollar of U.S. tariffs. How? By passing through a surprising partner, Mexico. Yes, Mexico has become the new gateway for Chinese goods into America. But how did this happen, and why should it matter to you? Once upon a time, China was America's top importer, and it wasn't even close. In 2018, Chinese imports to the U.S. totaled nearly $540 billion. But over the years, a mix of escalating trade tensions and economic strategies reshaped the landscape. As U.S. tariffs on Chinese goods took effect, a surprising contender emerged: Mexico. According to the U.S. Census Bureau, Mexican imports hit over $400 billion last year, a stunning 20% rise from 5 years prior. This growth didn't just happen overnight. Mexican manufacturing was already on the rise, but the trade war provided a catalyst, encouraging Chinese companies to set up in Mexico to access the U.S. market without directly facing tariffs. Now, Made in China labels are becoming made in Mexico, allowing Chinese products to avoid the costly tariffs designed to keep them out. But is this partnership really that simple? What are the economic and political repercussions of this new trade setup? In many ways, yes, the partnership is really that simple. Chinese companies have discovered a legal loophole in the U.S. tariff system. By shifting final assembly or production to Mexico, these goods become eligible to enter the U.S. at significantly lower costs, effectively outsmarting the U.S. tariffs on Chinese products. To illustrate, a recent report by the Wall Street Journal reveals how Chinese electronics companies are sending component parts to Mexican factories, where they're assembled into finished products. Once labeled Mexican-made, these products avoid up to 25% tariffs on Chinese imports. It's a clever, calculated strategy that allows China to stay competitive in the U.S. market. But what's driving this trend? And why is it happening now? Are the U.S.-China tensions responsible? Please like and subscribe. Your support helps us grow. Thank you. U.S.-China trade tensions aren't just impacting Washington and Beijing, they're reshaping economies across the globe. Mexico, which was already a significant trading partner, has seen a boom fueled directly by the ongoing trade war. When tariffs made Chinese goods more expensive to import, Mexico became an appealing alternative for American companies looking to maintain cost efficiency. The result: Mexico's manufacturing sector has expanded rapidly. In 2023 alone, according to Reuters, investment in Mexican manufacturing grew by 15%, as factories ramped up to meet new demand from both American and Chinese companies. Chinese businesses have invested in Mexican real estate, industrial parks, and logistical networks, transforming the country into a trade bridge to the U.S. But what's in it for Mexico? And how long can this economic boom last if it's tied so closely to U.S.-China relations? Chinese companies are pouring money into Mexico because they see a strategic opportunity. In a way, Mexico offers them a backdoor into the U.S. market, thanks to geographical proximity and the United States-Mexico-Canada Agreement, or USMCA. By setting up manufacturing hubs in cities like Monterrey and Tijuana, Chinese companies are laying the foundation for long-term access to North America. For example, Mexico's electronics exports, many produced by Chinese firms, have skyrocketed. In 2023, they hit an all-time high, driven by companies that want to sidestep U.S. tariffs. It's more than a short-term gain. Chinese firms aim to secure their place in the North American supply chain. So, who else is profiting from this influx of goods? What role do logistics companies play in this international game? Logistics giants are cashing in big on the U.S.-Mexico trade surge. Global firms like Maersk, DHL, and even Uber Freight have identified Mexico-U.S. trade as one of the hottest opportunities for growth. Maersk alone recently invested millions into expanding its cross-border operations, anticipating that U.S.-Mexico trade will continue to grow exponentially as long as tariffs remain on Chinese goods. DHL has opened new facilities along the border, optimizing their network to handle increased shipments between Mexico and the U.S. Uber Freight. Meanwhile, has launched special services for these routes, turning what used to be a small market into a booming revenue stream. But is this just a logistical win, or does it have broader economic ramification for America's border? Here's the twist. The very border designed to protect American interests is now helping China's trade strategy. U.S. Customs allows for certain substantial transformations of products in Mexico, which means goods manufactured in China and finished in Mexico can be labeled as Mexican-made. This loophole allows Chinese companies to bypass tariffs by assembling or modifying their products just across the border. It's ironic, but the very rules meant to control trade are now acting as a gateway for Chinese goods. Experts like Sarah McKenzie from the Brookings Institution have voiced concerns, calling it a flaw in U.S. policy that requires serious reevaluation. But it's not just electronics crossing the border. Why are entire car factories being built? Chinese automakers see Mexico as a strategic goldmine. Companies like BYD and Great Wall Motors have established factories in Mexico, focusing on producing electric vehicles for the North American market. With U.S. consumers increasingly looking toward green alternatives, these companies are positioning themselves at the center of the market. The strategy is clear: produce cars in Mexico, take advantage of U.S.-Mexico agreements, and avoid tariffs. BYD, for example, recently opened a facility in Nuevo León and is already sending cars across the border. But what do American automakers think about this, and could it spark a new trade showdown? There's a twist here. The tariffs meant to harm China's economy are boosting Mexico's. With Chinese companies moving production to Mexico, local economies have thrived, especially near the U.S. border. In 2023, manufacturing jobs in Mexico rose by nearly 10%, according to Mexican Industry Insights. The influx of investment has sparked rapid economic growth, making cities like Monterrey and Tijuana new manufacturing hubs. But there's a risk. Mexico's growth could become dangerously dependent on the flow of Chinese investments driven by U.S. trade policy. So, what's the role of the USMCA agreement in all this? Is it helping or complicating matters? The United States-Mexico-Canada Agreement, USMCA, was meant to strengthen North American trade, but it's offering an unintended advantage for China. Under USMCA, goods produced in Mexico, regardless of origin, can enter the U.S. tariff-free if they meet certain criteria. Chinese companies are using this to their benefit by completing their products in Mexico and classifying them as North American goods. Trade expert Laura Owens from the Council on Foreign Relations explains, "The agreement wasn't designed with this in mind. It's a strategic loophole that allows non-U.S. companies a competitive edge." What about the idea of substantial transformation? How does this fit into China's approach? Substantial transformation is the process by which goods undergo significant changes in Mexico, allowing them to be reclassified as Mexican products. In practice, Chinese companies are sending parts to Mexico, where they undergo minor assembly to become Mexican-made. This tactic is essential for bypassing U.S. tariffs, and it's why Chinese companies are investing so much in Mexican manufacturing. But it's also a source of controversy. Many argue it's a loophole that could lead to tougher U.S. trade regulations. But how does this impact shipping? Are there visible changes in shipment patterns from China to Mexico? Shipping data reveals a steep increase in shipments from China to Mexico. This isn't accidental. It's the direct result of Chinese companies building supply chains that move goods from Asia to Mexico. Since the U.S.-China trade war began, shipments from China to Mexican ports like Manzanillo have increased by over 40%, per data from Global Trade Review. It's a transformation that speaks volumes about the shift in global trade dynamics, and it's pushing Mexico to adapt its port and logistics infrastructure at a rapid pace. But what happens after these goods arrive in Mexico? How do they get to the U.S.? Cross-docking facilities play a crucial role in moving products efficiently across the border. Goods arrive from China, are briefly stored in these facilities, and are quickly transported to the U.S. These sites operate almost like transfer stations, processing millions of dollars in goods every day. According to Border Logistics Weekly, cross-docking has become a booming industry in itself. This streamlined process cuts down on shipping time, making Mexico's proximity to the U.S. a key competitive advantage for Chinese goods. But is Mexico's infrastructure prepared for this surge? What about the trucking industry? With the rise in trade volume, Mexico's trucking industry has never been busier. Trucking companies have ramped up their fleets, hiring new drivers and investing in technology to meet demand. But challenges remain. Mexico's road infrastructure is under strain and border wait times have increased. Analysts like Carlos Herrera from Transport Today warn that Mexico's trucking industry might reach a breaking point if demand keeps climbing. And it's not just transport companies adapting. Major corporations are getting in on the action too. Companies like Tesla and General Motors are placing significant bets on Mexico, recognizing the strategic advantages it offers in the current global trade environment. Mexico's proximity to the United States, coupled with lower labor costs and tariff-free access to the U.S. market under the USMCA agreement, makes it an appealing hub for automotive giants seeking cost efficiency and faster delivery times. As these companies ramp up production of electric vehicles and other high-demand models, establishing facilities in Mexico provides a crucial competitive edge, allowing them to avoid lengthy overseas shipping and the rising costs associated with Asian manufacturing. For Tesla and GM, investing in Mexico isn't just about cost savings. It's about positioning themselves at the forefront of a rapidly shifting automotive market. With Mexico becoming a vital link in North American supply chains, these investments also signal a long-term commitment to reshaping the production landscape, creating local jobs, and potentially transforming Mexico into a major player in the automotive sector. Mexico's rise as a global trade hub, especially with Chinese goods entering the U.S. tariff-free via Mexico, is under increasing scrutiny. American lawmakers concerned about loopholes that bypass U.S. China tariffs are pushing for tighter regulations and stricter border oversight, which could disrupt Mexico's booming manufacturing sector. Political shifts in the U.S. threaten the very trade dynamics that have allowed Mexico to become an essential intermediary between the two superpowers. At the same time, Mexico faces its own political balancing act. As foreign investments pour in, Mexican leaders must manage rapid industrial growth while addressing domestic concerns and maintaining cooperative ties with both the U.S. and China. Any misstep could unsettle its strategic role in global trade, underscoring just how vulnerable Mexico's newfound position could be to political winds on both sides. China's use of Mexico to bypass U.S. tariffs isn't just a clever strategy, it's reshaping the global supply chain. But what happens if America shuts the door on this workaround? Will Chinese companies continue investing, or will they search for the next loophole? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.